It's not so much the physical control, it's the contract control. And I'm so glad that you brought this up because we are absolutely inside of a structural shift in how gold and silver are actually priced in this market. And here in the US, it's primarily a contract market, and the level of the contracts is so huge that it's been dictating the price. But to your earlier point, there is a shortage of both physical and gold to the level of contracts. And so starting just recently with the backwardation in the metals, it really started in January when they shipped over with somebody with a fat finger, took delivery of all of that gold and silver. So that was really more the beginning of it. And then with the backwardation, that was a signal that the pricing mechanism is shifting. Throw the Bank of England in there as well, because their stores of both physical gold and silver are substantially lower than they were not even a year ago. So will there be a default? I mean, that's going to be like a huge fireworks. And I particularly bring up the Bank of England because they shipped an awful lot of gold over to the US in the beginning of this year, and they don't own a lot of gold. So whose gold are they sending over? And what happens when those countries ask for their gold back and the Bank of England doesn't have it? So I think those fireworks lay yet ahead, but I think it's much bigger and broader than just the LBMA. It's not so much the physical control, it's the contract control. And I'm so glad that you brought this up because we are absolutely inside of a structural shift in how gold and silver are actually priced in this market. And here in the US, it's primarily a contract market, and the level of the contracts is so huge that it's been dictating the price. But to your earlier point, there is a shortage of both physical and gold to the level of contracts. And so starting just recently with the backwardation in the metals, it really started in January when they shipped over with somebody with a fat finger, took delivery of all of that gold and silver. So that was really more the beginning of it. And then with the backwardation, that was a signal that the pricing mechanism is shifting.
The modern precious metals world is dominated not by bars or coins, but by contracts, vast paper markets that set global prices. For years, futures trading on U.S. exchanges has outweighed physical demand, suppressing signals from real-world supply constraints. But since early 2024, cracks have appeared. A sudden surge of large buyers taking physical delivery created unplanned drains on COMEX inventories. At the same time, backwardation, when near-term prices exceed long-term prices, emerged as a warning sign. These distortions show a shift underway. Physical market forces are beginning to overtake the contract-driven price system.
And then just recently, I was looking at ETF flows, and the flows have been, according to gold.org, the flows have been out of the system, and yet you still see the spot gold, the contract market, making, well, not new highs at this point, but toward their all-time highs. Whereas normally those ETF sales would have put price pressure downward on that spot market. So to me, that is an indication that the evolution in pricing, that the structural shift in pricing the metals is well underway. All of those things tells me that there is a shift that's occurring, and ultimately it will be a supply and demand dynamic for the physical metals themselves that will start to actually show fair pricing. It's all relative. Timing is relative, right?
Right.
So the answer is I do see that in the near future, but we still have some stages that we're going to have to go through first. We're going to have a complete loss of confidence. And so I pay a lot of attention to consumer sentiment, consumer confidence. because it keeps bouncing off the low. But when I see a breakthrough,
Gold ETFs have historically shaped price action. Heavy selling meant lower spot prices, but recent behavior has inverted that logic. Despite months of ETF outflows, gold prices continue hovering near all-time highs. According to updated 2024 reports, physical demand from central banks hit multi-decade records, offsetting Western investor selling. This divergence signals a deeper structural shift. For the first time, emerging market accumulation and sovereign stockpiling appear strong enough to override contract market pressure. Supply constraints, geopolitical stress, and a tightening physical market are reshaping the way gold and silver are valued globally.
to that low, to a new low, then for me as a technician, it will indicate that we have now gone to a much more significant level in that loss of confidence, because this whole fiat money system is nothing but a Ponzi scheme. And every Ponzi scheme always needs new money, which we're at maximum levels in debt, not saying they can't grow more, but maximum levels in unpayable debt. And they need they need confidence. And since 2008, I saw bank-to-bank confidence go away, as witnessed by the interbank lending, which they don't even report on anymore. So banks lost confidence in each other. Central bank to central bank confidence gone in 2015 with the Swiss surprise. And I can go into any of this in more detail if you want me to.
Oh, please do. That would be great.
Well, okay, but it might kind of derail the conversation. But the Swiss surprise, there was a period of time similar to what we experienced here in the US with the variable rate mortgages. In Europe, the Swiss franc was cheaper than the euro. And so people in Europe, a lot of people in Europe, took out mortgages in Swiss francs because it was cheaper. Their monthly payments were cheaper. But then the Swiss franc pegged to the euro, So whatever the euro did, if it went up or it went down, the Central Bank of Switzerland was obligated to support that currency, the Swiss franc, at the same level as the euro. But it was costing them a lot to maintain that peg. So through the IMF, the International Monetary Fund, which every central bank chief and every treasury secretary is part of, pretty much almost.
Every financial system rests on confidence, and that foundation is beginning to erode. Since 2008, trust has been breaking layer by layer. Banks stopped trusting each other, evidenced by the collapse of interbank lending transparency. Central banks stopped trusting one another after the Swiss National Bank abruptly broke its euro peg in 2015, sending companies into bankruptcy overnight. Markets stopped trusting central bank forward guidance when promised moves were abandoned at the last minute. Now only one layer remains: public confidence. With inflation squeezing families and debt ballooning to historic highs, that final pillar is weakening.
They vowed and vowed and vowed and vowed and vowed that their highest priority was maintaining that peg. And 2 days after they came out with that highest absolute priority was maintaining that peg, they depegged. In other words, it's called the Swiss surprise. You can go in, you can search it out. But there were a number of companies that went out of business. But the point of that whole thing was what the central banks learned. Up to that point, they had been doing everything in lockstep in a very coordinated way. You may recall that, or some of the viewers may recall that. Well, then central banks discovered that they cannot count on each other to do exactly what they're agreeing to, that they will do what's in their best interest first. So that was the second significant layer of confidence. So now we've lost bank to bank and central bank to central bank. The next one, frankly, really surprised me. And that was when the market confidence to the central banks, because since 2008, central banks had been using forward guidance to tell the banking system what they were going to do so that they could get into position to make money on it, get into the right position for it. And so leading up to an interest rate increase, the Federal Reserve, the ECB, the Bank of England, so the key central bankers had all been saying 50 basis points move, a 50 basis point move, a 50 basis point move. And then at the nth hour, without any warning, they did bam, a 75 basis point move, which may or may not seem like a lot to you, but when you're positioned for 50 and they do it at 75, that's a problem. And by the way, that's still a problem that exists.
15 years of near zero interest rates left governments, banks, and central banks stuffed with long-duration bonds that lose value when rates rise. After the fastest rate hiking cycle in modern history, many of those holdings are deeply underwater. Globally, more than $10 trillion in paper losses still sit on balance sheets. Institutions can't sell without triggering deeper collapses, creating an ecosystem of zombie banks and zombie governments sustained only through new debt. Meanwhile, central banks themselves are running losses despite being able to print money at will. It's a system stretched far beyond sustainability.
Because, this is my sterling silver chopstick, what that really did too, we had 15 years of zero interest rate policy, right? So it's zero interest rate policy. If this is a bond, this is interest rates, this is when it was issued, and this is when it matures, right? When interest rates go down, the market value of the outstanding bonds go up. So you can hide a lot of stuff with that. But when interest rates go up, the market value of the bonds go down. This is so significant. People do not realize we still have all of those negative bonds in the banking system, including in the central banking system, and not just in the US, but on a global basis. And so what that actually means, I mean, the Federal Reserve has not turned a profit. We're now in the 5th year. And they have an easy way to turn a profit because they just create money. And the difference in the cost of that money to create and the face value of the money is their profit. So how in the world are they losing money? But that's another discussion for another day. Having said that, what we have is we have zombie governments because that debt is unpayable and all they want to do is grow more of it. We have zombie central banks because of all of the government debt and other debt instruments that they are sitting in that are way underwater. And I'll put the banks in that same category. They can't afford to run because then they'd have to liquidate. Well, they'd halt it. But if they didn't, they would have to liquidate these undervalued bonds, which would make them even more undervalued and just exacerbate the problem. But so then it was in 2002, it was the markets realizing they could not count on the forward guidance of the central banks to tell them what they were going to do.
The world is now transitioning toward a new digital monetary framework. With the authorization of U.S. dollar-backed stablecoins, corporations can issue their own digital dollar instruments backed by treasuries, creating an artificial new demand source for government debt. But this shift also brings risk. It fragments the dollar system and may accelerate inflation if money creation becomes decentralized across private issuers. Many analysts believe this transition could trigger a final phase of hyperinflation, wiping out existing debt by destroying the currency's value. In that scenario, physical assets, especially gold and silver, become the ultimate anchors in a collapsing system.
There's only one layer left, and that's public confidence in this crap and in those that are managing this crap. And rapid inflation erodes that confidence. So if central banks, their real job is to manage the rate and speed of that inflation. So if they lose their ability to do that, I mean, and a lot of people, I mean, look, you've got families that have to buy their groceries on 4 easy payments.
Yeah.
You have, I mean, what does that tell you? People lose confidence when they can't feed their children. And they're making more dollars The problem is not that those things are worth that much more. The problem is that the dollar, the euro, the yen, take your pick, is worth that much less until it has zero value. And it only has 3 cents officially. It is an inevitable scenario because the new monetary system that they did just put in place when Trump signed the Genius Act and legalized stablecoins, it was to create an artificial market for dollars. And corporations, any corporation can really issue those stable coins. So it's also going to be a very fragmented market. But really, what's going to justify, this has been my question for many years, and it was finally answered, right? What's going to justify new money creation? In the current system, it's debt that justifies that, right? Just grow more debt, take on more debt, whether it's a consumer debt or corporate debt or government debt, whatever. All that debt creates more dollars. In the new system that was just legalized, it is your purchases that are backed 1-to-1 with dollars that then that corporation has to turn around and buy treasuries. So what President Trump is attempting to do is to create a new artificial market for dollars and for treasuries. Part of the challenge is the stability of the hands that it's going into. The other part of the challenge is there is no doubt in my mind, this is my opinion, I could be wrong, but I've lived through currency changes before in the past. I'm very glad to be as old as I am, to be honest with you. And there's really no doubt in my mind, but that the Stablecoin Act is what's going to usher in that hyperinflationary depression that we have to have so that that debt can be repaid with dollars in this country that have zero value, and we can start cleanly in a new system.